All right. Well, folks, thanks for coming back on board here. I know we had a lot of you on from the first part, so thanks for coming by for part two. Just an opening on this. So I don't know. The last time I gave this presentation was probably a couple months back, and I had a lot of people that just totally agree with the concept here. It is probably better to break these products up. Instead of selling a long-term care hybrid policy, life and long-term care hybrid, you're almost always better off to break the plans up. So a separate long-term care. So those of you that missed the first part, it's a pre-recording. I think they sent it out. But the question that was asked, and I totally agree, is, well, I can see that this is a better option. How do you go about doing it? And that's like the million-dollar question. I mean, I for 2 months, I've been thinking about because I've actually, for almost 2 years now, I've been doing this concept in webinars for small groups, for agencies, individual trainings, talking with brokers around the country. I've tried to tell them that I've been screaming from a rooftop that breaking the products up is almost always better, okay, than selling a hybrid. Selling a hybrid is just, it's a solution that we've run to so much in this industry. In reality, it's not the best solution. So how do you get agents that are already doing this to turn their heads and maybe look the other way and change their habits? We all know we're all creature habits. I'm guilty of it. I've sold a hybrid or two back in the day. And so that's the challenge here. And so I've thought about this for 2 months. I put some things down on paper here, and I'm going to go through a couple things, the things that I would do, and things that I would say to my clients. But at the end of this, I kind of want to throw it out to you because we have a lot of very good, I guess, long-term care luminaries on this call. People that have written long-term care for decades, if you will. And so I do have the attention of some very influential or knowledgeable long-term care agents. So I'm going to kind of throw it out to some of your opinions here when we're done. So look for that. Before I get started, I touched on this yesterday. And by the way, this presentation will be sent out to you at the end of this webinar. Short webinar today. It's maybe 20 minutes here or so. This is a topic that, I'd be remiss if I didn't mention coronavirus right now in this long-term care industry. If you've been following anything in the industry, we know that people right now are deathly afraid of nursing homes. 61% of people, surveyed said they'd rather die than go to a nursing home. I touched on this yesterday, but we do it with every webinar right now. There are just, 3/4 of people that have died from COVID in Canada were in facilities. Facilities are facing incredible costs right now. With the COVID, with the trying to find reliable help, they have to pay them hazardous pay. They have to buy extra, protection equipment for their employees. They have to do cleanings. They have to separate people. The 95% of nursing homes operate a loss as it is. These extra round of costs are just going to crush these nursing homes and facilities. The crisis for this facility thing, the reason I'm saying all this is there has never been a better time to be a long-term care agent. Right now, it's hard to say it, but the public needs us. For those of you that have been in long-term care a long time, and I've been in it for 24 years, I can't think of a time where there's been more people. The same study that's referenced in our Corona six-pack here that you're looking at, they talked about how 85% of the country right now is believing that long-term care planning is very important. 81% believe that long-term care insurance is important. I mean, just look at like 5 years ago. 30% of people, think they should buy long-term care, or, we've never seen a time where people are more afraid. And I'm telling you, if you just talk to your clients about it, we have some pre-approach letters, conversation starters, but I promise you, if you haven't done any long-term care mailers or approach letters or sent something out to your clients, now is the time. They need us. They're afraid, and it's an incredible opportunity to talk to your clients about a very important benefit that I've always thought has been important. But anyways, this Corona six-pack, when you get the link for this presentation, if you click this hot link down here, that will give you access to these, at least, well, we call it a six-pack to be cute here, but we just put together a bunch of marketing materials that can help you, I guess, educate your clients, put your clients' minds at ease. Remember, we have home care only products, short-term care. So even if they can't qualify for a full-blown, but they're already, it's on their mind, we even have True Freedom. So as long as they're, they can fog a mirror, we can get them some home care. So the point is that people are looking for this information. Check out this six-pack. I promise you it'll be full. It'll give you some ideas on how to sell more. All right, so back to long-term care. We still believe that it's a big problem out there. The need for long-term care is still strong. So we come down to how, what's the best way to go? Just pause here again. I was looking at my LinkedIn this morning, and boy, every time I do this hybrid versus long-term care, traditional long-term care, you get the hybrid people that they get a little bit, I don't know, mad's right the word. It causes some conversations. Have you thought about this? And this is the, I don't know, 6th version of this that I did yesterday. I've tweaked things. Like, you know what? I overlooked this. I've overlooked that. I am very open to any flaws you see as I go through these comparisons. I did Nationwide, Pacific, I did One America, I did Securian. I go through all these different hybrids, and every time I do them, separating a long-term care and life policy, unbundling, if you will, is the way to go. Now, I do have people that still try to, point this and that, and I welcome that. I always look into these things and try to, there's guaranteed, there's paid to 100, there's paid to 95. There's small little details in there that, but at the end of the day, even if you worry about rate increases or anything with long-term care, you're winning the premium race by so much that you have more money to go ahead, just buy a little bit more life insurance, or you can tweak a little bit. Mine are just pure examples, but there's so much more weight in the separating them out scale versus bundling them that I'll talk with anyone that wants to argue a hybrid over traditional long-term care with a life. But anyways, okay. So what do you do then? I go through these comparisons, and you guys have seen these. I did these yesterday, right? I did this comparison. You're used to seeing this from yesterday. So how do you get there? How do you get people from after you went through a presentation? And, it's a long presentation. You spent 45 minutes convincing they need long-term care. Well, now we have to bring them solutions. And here's just the fact of the matter. And this is, again, an agent of mine down in Florida, and I discussed this. If you pitch traditional long-term care to somebody, and you're telling about, this is how long-term care works. This is why you need it. You create this need. And you tell them about how traditional long-term care is and how it's going to take care of this problem for you. But if you don't mention hybrid, if you literally just skip over the hybrid long-term care, what happens? Well, this guy tells you he wants to think about it. He goes home for the weekend, and maybe his brother-in-law's, over for the weekend watching some of the basketball games in March Madness this year, and he tells him after a couple beers, well, did this guy tell you about hybrids? Well, no, he didn't. Well, then he doesn't know what he's talking about. There's really two things that people do here. And, the traditional long-term care, you just use it or lose it. You die in your sleep. Well, pretty soon this guy that you had convinced needs traditional long-term care looks at you like you're kind of an idiot because you didn't even bring up hybrids. And this guy's now leaning hybrid because his brother-in-law told him so. Or some financial planner told him it's a better way to go. Or wherever he got the information, you didn't tell him about it. So as an agent, you're almost obligated to bring up this hybrid thing. You kind of have to. So when you do, there's two ways to take care of this problem. There's a traditional long-term care and there's a hybrid. And I tell people, this is my take on it. I would tell my clients, some people do worry about the use it or lose it factor of long-term care. So what's happened is the insurance companies have introduced these things called hybrids. Okay, so with a hybrid, you die in your sleep. Remember, well, you get a death benefit, and we know how that works. So this is where these things came from. So what they've done then is they've bundled the products together because, Americans love bundles. Look at Flo there with Progressive, right? It's all about bundling your home and auto and car and motorcycle. And we love to bundle things, cable packages, cable, phone, TV, internet. You'll notice, by the way, sometimes in those bundles for like communications, your cable and they charge you like $60 for a landline. And I always wondered, like, why would you bundle that when you can get a Magic Jack and have phone for free at this point, or use your cell phone? Well, in this world of bundling, similar things happening here. These hybrids, they're just overpricing the life so badly that the bundle is actually hurting you. So I'm telling you, quit bundling. Quit bundling these things together. The only person who's coming out ahead when you bundle together and sell a hybrid, your client's losing big time. You as an agent, you're losing. I have a slide here that's going to talk about commissions. You're taking the shorts on your commissions a lot. The only person who's making money on this is the insurance company. We've been duped as an industry. We've been duped into selling these hybrids as this some kind of great solution for use it or lose it. And I'm just here to tell you that we got to change our thinking, okay? Because bundling, not so good, at least with the hybrids, okay? Maybe some other bundles are decent. I want to make Flo mad, but okay. So this is the example that I used, and I tweaked this. That's why I put it in here again real quick. This is the example I use against One America. Why One America? I'm gonna break this one down a little further and talk about how I would compete with this if I'm an agent selling to my client. All right, so this is the example that I use. I switched this out. I actually put the Columbus Life quote in here and I've got a snapshot of it because the one I was using was with Prudential. This was $2,100 for a $166,000 death benefit. So just to recap super briefly here. So this is a couple examples that I use. Okay, so what I use here is, let me go back in presentation mode. Okay, so the example I'm using here is this is a 65 and 60-year-old couple, and One America, if they don't have continuation of benefits, just having a 3-year plan, 33-month benefit, and that with inflation for a 65 and 60-year-old to have a $5,000 a month benefit with a $166,000 long-term care benefit, their premium on that is $10,243. Remember, if I take a separate long-term care plan at $5,503, and then I take a life premium at $2,408, this is Columbus Life's, by the way, not Prudential's. My total then is $79 versus $10,000, or over here, instead of $19,000, it's $13,000. So, and this is by the lower one here, I went ahead and did the continuation benefits, because that's kind of that to me, you can argue hybrids and non-hybrids. The fact that traditional long-term care doesn't have an unlimited benefit, well, yeah, I guess you could hang your hat on that. We know that 90% of claims don't go beyond 2.5 years, but for these, how many claims go beyond 5 years? Like less than 1%. Beyond 10 years, it's so. Yes, we're talking about if you have to have a limit, which I think is silly, but if that's really what you have to have, that's an argument I'll make for One America. That's one of those things that traditional long-term care doesn't have. So if this client of yours is hell-bent on saying, I want unlimited, you're kind of forced to go there. So the example I use here, I use a $500,000 pot of money, and I inflate this over time. And so if, my next slide on this one, I end up showing a benefit value of, it's a pot of money of $1.348 million, which lasts for like 17 years. So it's like 99.45 or 0.6% of all risk is wiped out. It's not unlimited, but it's dang close. You can get, and again, it's $6,000 less, or some 33% premium less. So these two examples, I guess I would, if I'm talking to a 63 and 60-year-old couple, and I've talked to them about long-term care, and I got back to the slide here saying, you know what? So we're down to two options here. If you do pick hybrid as your option, if you think, this use it or lose it thing, Jeff, it does bother me. I guess, I'd be more inclined to look at a hybrid because I'd be worried about that, that use it or lose it factor. And so I would just offer my clients both. I'd say, here's traditional, here's hybrid. And so, and again, I would show them, okay, if you are going to pick this hybrid, then don't bundle them. If you're worried about getting your money back, and that's why we're looking at hybrid, because that's why people look at hybrids generally, right? It's not, if they have $100,000 laying around in a useless life insurance contract, they're going to do a single pay. Well, then we just do a hybrid. We move on with our day. We don't worry about this. But that's not 95% of long-term care sales. Most of them are people have called you to try to solve a long-term care need, and we somehow we're cramming life insurance down their throat to make a solution. So the hybrid thing, if they're going to go there, it's because of use it or lose it more often than not. Well, then again, I tell them, let's not bundle this. Okay, bundling is not good. So I would tell them, remember, this is how it looks. This is how much more. If you look at this one, it's $6,000 more to do this in a bundle. All right, and remember, you end up getting both benefits. With the unlimited, you get your death benefit either way. But in the other one, you get one benefit or the other. If you use up your long-term care, you don't get your death benefit. And so, there's drawbacks right at the start. First of all, it's a lot less premium. You don't get both benefits guaranteed. And by the way, your benefit, this example I'm using here, I have a $13,000 a month benefit versus a $9,000 a month benefit 20 years down the road. So, I get the smaller pool. I'll argue the short end of this, that I have $13,000 in benefit versus $9,000 in benefit, and my premium is only $13,000 versus $19,000. Again, I don't want to do this dead dog. It's always better breaking them up. So, what did I do to break these up? Before I do this, I have one more note on commission. I touched on this earlier. It's great. These hybrids are not a good deal for the client. But did you realize how not a good deal they are for you as an agent? I didn't want to put actual comp schedules because we've got agents from all walks of life here, career shops, shops like, career contracts like I'm on here at GoldenCare, but I don't care what contract level you're on or what percentage that you're on. Traditional long-term care has a very large first-year premium, same with the life, same with the hybrid. So, and then if you look at the renewals, long-term care, will pay you a flat amount for Mutual Omaha anyways, for years 2 through 30, 40, etc. Average long-term care policy is held for 28 years, 28.8, whatever it is. So you're getting renewals on that. So that renewal base is actually a lot more than your first year commission. So if you add this, now your life, of course, you get a one big, huge pay to begin with life insurance, then you get a very small little trail, right? But that still adds up. But that only pays years 2 through 12. This was the Columbus Life contract I looked at. Prudential was similar. They were 2 through 10. Then I have the hybrid. The hybrid plan here was, a larger, it was in between the long-term care and the life. Let's just say it's a little bit more than traditional long-term care, less than life, but still a large amount first year. Then you get this small little amount for years 2 through 10. Now, again, I don't want to put the numbers in here but when I did this, no matter what level you're on, you're getting paid. You add up the traditional long-term care and a life compensation, it's 33% more comp than if you sell a hybrid. So you're basically losing 1/3 of your pay when you sell a hybrid. And if you know the commissions on these, if you look at that one, the example of the 19,000, well, I mean, this example here, you're losing like $7,000 in commission. So it can add up 33%. And if you're an agency or a shop out there, with our shop, we've been trying to tell our career guys that you need to be breaking these up. It's a lot more. There's just a lot more money for the agency, for the agent, for everyone involved. Again, I'll say it, and this is probably a little brash, but the only person making money on hybrids is the insurance company. Agents losing, clients losing. All right? Okay. So first thing I would do, if use it or lose it is their thing, and they want to get their money back. I touched on this briefly, but it was kind of running long, so I didn't. But I wanted to bring this back as solution number one. With Mutual Omaha's long-term care plan, which is, let's face it, it's a Cadillac out there. There's so few left now. I use Mutual Omaha for most of what I do. Okay. So they have this 3 times, return of premium rider. They have 3 times your maximum monthly benefit. The example that I used, that $10,000 a month benefit in my One America, well, that means you get $30,000 back, each husband and wife. So you get $60,000 back of your premium. These are a 60 and 65-year-old couple. So right away, if use it or lose it is your concern, instead of taking a premium that was going to be $5,500 up to $19,000, I would say, on that, $5,500 up to $9,000 without the inflation, or $10,240 and $19,000 for the unlimited. So in other words, instead of doubling the amount of premium that they're going to be paying, I would just tell them, for a very little load, this 3 times monthly maximum, it's like $500. Let's take a look at that quick. I think I have my software open. No, I don't. Bear with me here. Let me bring this open so I can show you what I'm talking about. So this would be option number one for me. I would more or less say, look, if you want half your money back, in case you die in your sleep and you never use this, there's a lot of, so I'll show you a very inexpensive way to get half your premiums back. It'll cost you next to nothing. When the software comes up, I'll show you what I'm talking about here. So let's just do a 60 and 65-year-old couple. Okay, I'll do a $10,000 a month benefit. And forget the pool I put in there. I think it was $250 or $400. Okay, so I put this down at 1%, I believe it was. I think I had 200,000 here. Okay, 250. So if you look at the premium here for a 60, 65-year-old, so they, $10,250, 1% inflation. This $10,000 monthly benefit, upon death, if I add this, look how much it adds to the premium. So this couple's premium right now is $64.48. How much is it if I add this? If I give them basically $60,000 of that premium back? So average claim happens at 83. So these people are going to pay in about $120,000, $130,000 in premium. I can get them half that back by doing this. Boom. What do you have to be? Ages of 64. Let's put it at 64. Then you have to be under 64. All right. So for that load, what's the state in Alabama? Maybe we can do it in Ohio. So look at the difference here. For about $300, right? You see this? $400 more annually. And by the way, where are you getting a $30,000 burial for a 65-year-old for $125 a year? You're just not. I mean, I've been telling my brokers, look, they're giving you a built-in burial to every long-term care plan you're selling. Forget anything else we're talking about today. This is a heck of a deal, right? If you're selling and I'm a big believer in a higher daily amount, a monthly amount, and a shorter benefit period type thing. We call it short and fat. I had a discussion about that yesterday. We should call it something a little better than that, but just a more robust benefit to begin with. Okay, so if you're selling this strategy, which I think is better, anyways, look at how inexpensive that is. It's $400 to add a $60,000 worth of life insurance in there for next to nothing. So there's half their premium back. Then you come back and sell them a $60,000 second to die plan for $900 a year. So you can just kick the liver out of a hybrid by doing this. Okay, but so that's one option I would do. If you're, I'm kind of concerned, Jeff, but it is insurance. They don't give me money back on my car insurance if I don't have an accident. They don't refund me if I don't, use this insurance or that. So this is insurance. You get tax deductions for it. So that would be the first thing I would do is I'd tell them, look, I'll get you half your money back for next to nothing. Okay. Otherwise, okay, so scratch that. All right. I want all my money back. And what if there's rate increases? What if I want to make sure that I'm whole at the end. Okay, well, fine. Okay, at that point, we're going to go into the life thing. So here's what agents tell me. The life insurance thing, well, I don't either have a long-term care. I don't have a life. I'm more of a long-term care person. I do hybrids, but I've never really done life. Let us help you get over that. We have a bunch of companies that we do for life, and I'll be the first to tell you, we're not a big, strong life insurance company. But because of this concept I've been doing, I've been pouring through, F&G, Columbus, Prudential, Great Western, Mutual Omaha. I've been breaking down all these, IULs, index, universal life, flexible premium, universal life, second to die on the universal life chassis. And so there's a lot of products out there. If you don't have one to do this, we're kind of suggesting right now Columbus Life has been the one that's been a little more versatile, has a lower amount on the second to die. Some carriers only have a minimum of like $200,000 on their second to die, and we don't need that much. If I'm comparing to a One America, which I'm doing in this presentation, they have a second to die chassis on their life portion. So, adding that is really easy. As far as getting quotes, we'll show you how to go onto the, Columbus Life's website so you can, pull your own quotes, or we'll help you with that. By the way, their e-app, for those of you that maybe are writing One America, you'll recognize this. It's the same format. So the learning curve to do a Columbus Life app is not that much. And honestly speaking, when you're already doing a long-term care app, because that's one of the drawbacks, people will tell you, well, look, I have to take 2 applications. This client, so it's 2 applications. I hear that a lot. I'm like, yes. They have to fill out 2 applications. Well, they're not going to fill out. You're going to do most of it, right? Just send them percentagers. But if I'm saving them $7,000 a year for 20 years, that's $140,000. Tell me what client isn't going to sign 2 sets of papers to save $140,000. So we need to stop this. Well, it's too ass. We can't do it. It's too much trouble. So again, I come back to, all right, so the clients take it in the shorts of the hybrid. The agents take it in the shorts of the hybrid. So the reason we're doing this is because we're too lazy to fill out a second application. I don't buy that. It's not that hard. And maybe what you want to do is you want to take that long-term care app, get the process started, see if they get underwritten, see if they get accepted. And you can always come back the next day or the next week and go, let's get this life portion started doing too. If use or lose is still your concern, let's go ahead and get that life portion started. Instead of asking to commit to this super expensive hybrid right away, I would argue that it might be easier to start the long-term care app and then maybe finish the life app, the next day or the next week. So anyways, it's just a simple little app. So when designing these things, Lynn put these in here because, when I am trying to compete with a hybrid, the fact that I have this unparalleled flexibility, and a lot of long-term care plans have this, but the Mutual Omaha is really good at this. I think I showed this slide yesterday where, same pot of money, $270,000. I can do this with, higher inflation, lower inflation, just a higher daily amount, change it to $10,000. I'm more of a short, fat person over here. I like doing a more stout benefit to begin with because, again, so many claims are in the short run. And this also allows you to get that 3 times monthly benefit better, brings those premiums down, and your payouts, are going to be very similar if you look 20 years down the road. So just the fact that the mutual plan is the most flexible, chameleon-like product allows you to really compete with these hybrids. So it's the best tool I can find to compete with them. And that's again. So I am using this short and fat. So what would I do then? if I'm going into this couple and I'm showing them this comparison, I would just pull these two or one like it. Maybe you have a copy of my presentation here and you've got some of these laid out. So if they're looking at One America, maybe you pull that one, or they've seen One America, they've heard about it. I would just show them the numbers on this. So in other words, if you're thinking about buying a hybrid, would you like to pay $13,000 or $19,000? They're going to look at that $19,000 or the $13,000 really hard, especially when you tell them that you get both benefits and you get the same benefit payout here, right? I'm getting a death benefit. I'm giving you a long-term care benefit. Why would you spend $10,243? And by the way, let me just touch on this: the quality. When I'm selling and I feel like I'm just picking on One America. They're the biggest kids on the block, I guess, with this. So we do sell One America here. So what are the hybrids doing? Well, they're a reimbursement contract on the long-term care end. And any of you guys have been in long-term care as long as I have, or if you've been in long-term care for any time at all, we know how important cash is. What happens in claims? Well, 80% of claims start at home, and 3 out of 4 home claims, 3 to 4 people receiving their care at home are relying exclusively on family and friends. So again, whatever one percentage of that, 58, 60% of claims are family and friends. Without a cash portion of some kind, without some type of a cash benefit, you can't pay your spouse, because there are always going to be fraud in there where companies aren't going to pay your spouse. I don't care if she's a licensed, home health care agency or not. They're not going to pay us, but they'll sometimes pay a daughter if the daughter is employed by the home care agency that's been approved by the carrier to do the care. Again, longer shot. But it's family and friends that do all the care. So without the cash, you're just not able to pay the people you want to pay. You're not able to get the kind of quality care or the convenience of care that you want to get. We all know that reimbursement. So when you do the One America option, and I would tell them, I'd harp on this, you're not getting as good a long-term care, which is why you called me to begin with, is you were worried about, you wanted to stay at home, you wanted to, maybe your daughter's going to help. So I would harp on the fact that and you're also getting a second to die. You're not getting universal life. You're not getting the guarantees. Both of you get a death benefit. Maybe you don't even need extra life insurance. Or maybe if you do want to get if you're looking to get your money back, maybe you want a first to die. So that way when the husband or wife does die, you can pay out the bills, pay for the funeral, pay out the extra expenses that come with that, losing that income. Or so, a second to die, I'm not sure is the best fit for but that's the cheapest way. A reimbursement contract and a second to die life is the absolute most inexpensive way to package a hybrid together. And then what you want to do is you want to pay the agents, as much as you can. So One America actually has some of the better pay on these things, which I think is another draw for people. They're making money on these things, right? So the quality of care when you break them apart is going to be much more. But this is the other thing I would harp on. Here is a quote, for example, of the 2 examples in my thing. The 2 I've done here: 10,243 and 13,155. Okay. Remember, when I break them up, I'm using Columbus Life at 2408 for my second to die death benefit. So look how much the life portion is in this. More than twice as much. So and I would show my client this. All we're doing when we put it into a hybrid, okay, we're just going to overinflate the cost of your life insurance premium. Okay, so one of these is continuation of benefits, and one of them isn't. Okay, so the $19,000, this one has continuation of benefits in it. That's why the LTC premium is $13.95. And by the way, look at this for the continuation, almost $14,000 for the long-term care plan. The annual long-term care premium is $4,900. In my example here, it's $5,500 for the long-term care portion. So that's pretty close. So naturally, One America's long-term care benefit in this example is just under the $5,500. So that's not really priced all that out of whack. But remember, it's a reimbursement. So if it's my client, I'd say, look, to be able to pay the spouse, the family members, the friends, the people who actually do the care, if you don't want to be frustrated for the same amount of money, I'm going with a cash portion, for $5,500 every time versus for it's $5,500 or $5,000 for 10% more premium. I want the quality. I don't want to have the, reimbursement model where I basically can't use it until I go facility, right? It's pretty hard to get the home care. It's just, what a pain in the butt. All right. So all you're getting, and I would show them this. Here's what I would do instead. I would take this long-term care premium, and you can have a quote ready for them with this $5,500. Show them that's $5,500 for this long-term care, right? And instead of coupling that with a $5,200 second to die life contract for $166, because that's what it's paying here. It's going to pay a death benefit of $166,667, right? I would show them that this Columbus Life, here's for a 65 and 60-year-old, here's your annual premium for that life, $2,408. Simple math tells me that's $2,700 less. In the example, what's the amount there? It's about $2,500 less, right? So that's where it's coming from, right there. So just simply point out to them, look, if you want your money, if this is, first of all, I'll give you half your money back and charge you almost nothing, really. Forget $2,400. For a couple $100, I'll give you half your premiums back. But if you really have to have all your premiums back, or let's just say maybe you're worried about a rate increase. Who says we can't put this death benefit at $200,000 in case we see a 20% rate increase down the road, or 30 or something? Which again, they're less likely. We talked about that. The Society of Actuaries has de-risked long-term care as the rate increases that we've seen in the past. But whatever, people are skeptical, and I don't blame them. You can always put a little bit more death benefit in here for a couple more $100. I think I did one at $200,000. It was like $2,900 somewhere in there, $2,800. So you could bolster some more in here to make sure you're getting all your premiums back. All right, but certainly just to compete with what One America is doing here, that's what I would show, I guess. So those are two thoughts I had, is what I would show my client. I would show them. Be prepared to show them a quote of comparing these things. Here's a 60, 65-year-old couple. Had this quote ready, had that one. So all you're doing is you're just overpaying for your life. If you're really worried about getting that, separate it. And listen, folks, I don't care if you buy a universal life, an IUL. The example that I'm using, of course, this is a Expedition S IUL, second to die, indexed universal life. So the carrier doesn't matter. If you want to use a first to die, a second to die, if you want to use individual, maybe we're just going to insure the husband, not insure the wife. He's probably going to go first, so we don't really need to we just put more life insurance on him and not worry about insuring the wife, because we'll just put twice it on him, and that we'll get her premiums back via his, life contract. It just, if you separate these policies out, you get so much more flexibility, so many more places to go, and you're going to save your client a lot of money. All right. Another thing I talked about briefly yesterday is the tax deductibility. If you look, these premiums we're showing you, by the way, it's hard to get someone to write a $10,000 annual premium or heck, a $19,000 annual premium. That's not an easy thing to sell. Realistically, most of the policies we sell are closer to like, $4,000 a year for a married couple, maybe, $3,000. So when you start comparing that to a One America or a hybrid, the long-term care and the premiums here, so the annual premium in this one, $49.95 for a 60, 65-year-old. If you look at the tax deduction guides, I believe it's closer to $2,400 they can each deduct off their long-term care, up to 31 at that 60 to 61 to 70 bracket. So their portion is only about $2,400, so they can't get to that full $3,000. So you're not quite able to deduct quite as much more often than not with the hybrids. If it's a large unlimited hybrid, well, then you got plenty of room. But for a lot of them, we're not selling these $19,000 premiums. In reality, they're a little bit lower than that. And so you run into a little bit of issues getting your full deduction. Again, not deducting as well, not getting paid as well as an agent, clients overpaying for life. The people who are making the money on these hybrids are the insurance companies. And we as an industry, I feel like as agents, as I'm a long-term care specialist, I've been duped. I really feel like I can't believe that we don't look at this more. Now, having said all this, is it taking two applications? Is that going to be the hard part for you? That might be, because as I try to put together ideas and things to tell agents, why are you doing this? I've thought about this for weeks in preparation of this, where I'm just not sure, because I've had multiple people call me, go to my LinkedIn. They say, Jeff, you're absolutely right. We should not be bundling these plans together. But I'm just not sure how to convince people to stop writing them. It's like we've gotten into this habit, and we've got agents that literally used to write us $100,000 in long-term care a year are now doing all hybrid. I'm sure they're still doing it for us, through our office. But I reach out to these people, and I can't get them off the hybrid thing. With the folks I'm seeing on here, these are some people that have written a lot of long-term care. We've got some heavy hitters on this presentation. There's 79 people on here right now. And I got to tell you, some of these names are names that I know write a lot of long-term care. So, if you want to shoot us, at marketing@goldencareusa.com. I would love to hear a couple of your ideas, and I'm going to add them to this presentation. How would you go about, if you were tasked with talking an agent who writes hybrids into how to, pointing out the fact that maybe there's a better way to do this, maybe breaking the products up is a better option, how would you go about doing that? I would love to hear from you. Any flaws you've seen with anything I've said today, I would love to hear from you. Folks, I'm just, what I've done for 25 years, and I guess the last 17 years, 18 years as a regional director is I try to help my brokers, my agents out there solve the long-term care solution as best as we can for that client. I'm not married to any carrier or any certain kind of product or anything. What I want to do is simply find the best solution for my clients. And that's the premise behind this very webinar is that, there are better solutions, and I don't have all the answers. I know that it's wrong. I can point out every way that it's wrong to do, but it's hard to convince an agent to do this. So I'm going to read through a couple questions here. And again, if you could send an email with your thoughts to marketing@GoldenCare USA, I would super appreciate it. Okay, there is a stat here, and someone's asking here, there's 62% of people would rather die than go to a nursing home. There are 3 or 4 stats like this. 81% of people are planning for long-term care. 85% of people think that long-term care is important. It's from and I'm forgetting the name of the survey, but it's in our COVID 6-pack. When you get a copy of this presentation, click on the link there. It'll get you the 6 marketing pieces that come with that. And that survey is referenced in there and all the stats. There's a lot more stats than just that one, by the way, that are in there that's outstanding. Okay. So there is a question here. You know what? Actually, the person's already left. What do you do for a 1035 exchange from life? We can't. The long-term care companies have never, and I did say that in my meeting yesterday. Look, there's situations where people have a dead annuity sitting there, or they have a life insurance contract that's not doing anything anymore. Well, then I think the hybrids, that's what they were designed for. That's a perfect, this is probably less than 5% of the situations we run into as agents that someone's got $200,000 sitting there that they got to get rid of, right? They do happen. I'm not saying they don't. They do, depending on your client base. But that's what I think the hybrid's a good fit. Is that's a good reason to sell them. In my original presentation, I do talk about, look, there are a lot of good reasons to sell hybrid, but for use it or lose it, that's not a good one. That's not one of the reasons that you buy a hybrid for it. Because you have a dead annuity, or maybe you want an unlimited benefit, or maybe you want an all-cash benefit, or maybe you just won't buy traditional long-term care because your brother-in-law's a financial planner and he said it's the dumbest thing in the world and you'd be mocked and ridiculed if you ever bought a traditional long-term care plan. So you're being guilted into buying a hybrid. Whatever. There's situations where you have to have the hybrid. 1035 exchange, that is one of them.
This is Tom Randolph from GoldenCare. Jeff's having some technical problems trying to get his phone back working, so I apologize. This is Tom Randall, National Marketing Director from GoldenCare. I want to jump in just for a second as Jeff's trying to clear that up for those who are still on the line. First of all, somebody asked about that 61% stat. Just to let you know, that is available on the COVID area, but it is a Nationwide Retirement Institute that was doing a poll by the Harris poll. So that was where that 61%, there's a lot of great other stats in there, like 71% of the people would rather stay home for long-term care. 68% would love to use a family member. So it's some of the reasons why those cash policies are nice for the home care, especially during these COVID times. And one of the other areas that Jeff talked about on 1035 exchange, I do want to clarify when he said it wasn't available for sure with long-term care. He's correct with mutual and most of the lifetime pay long-term cares out there. NGL, I believe, and I might be wrong, let Jeff know through the marketing line if I'm wrong, but I believe NGL long-term care does allow 1035 exchanges, with certain parameters for their single pay and their 10 pay. So there are some opportunities for that. But Jeff inherently was right on that, talking about the hybrids.
Hey, back up, Tommy. Can you hear me?
Those things. Yep, I can hear you, Jeff.
Okay, great.
I'll turn it back over to Jeff. Jeff, I just filled him in on.
Okay. No, I heard. Actually, I could hear you, Tommy, okay. But I couldn't talk anymore, so I think I got it solved.
Okay. Go ahead, bud.
Thank you, Lynn. All right. I guess I got a phone call on the other line, and it bumped me off. Okay, so, folks, thanks a lot, Tommy, for that. Just reading through the last couple of questions I got here, folks, and we'll kind of wrap this up. And I do appreciate all these comments. This is great. Some of you are saying, I love the idea of breaking them up. It's too bad the cash benefit lowered to 25% from 40%, which is true, but this is why that higher daily, that monthly amount, when I use 10,000 instead of 6,000, well, then the 25% is right back up to that 2,500 2,400 level where, I think it caps at 2,400 or used to. So you can still get there by using a higher monthly amount and then a lower inflation rider. And the payout, if you do extrapolate over 20 years, it usually nets out 25 years later or so. That 40%, 25% cash thing, we have a totally different webinar about this to how to address that. But I still am a big believer in selling higher monthly amounts and lower inflation. Okay. I got someone else here that, all right. Wow. Well, thank you. I'll just call him Roger. No one's ever shown me the actual numbers. I'm definitely converted to doing long-term care with life instead of a hybrid. Thank you. And this is my whole point of this, is most people that see this are convinced. They agree with me. We should break the policies up. It's just getting people's mindset changed to get away from bundle. That's the challenge here. So, another person saying it's because they're not familiar with the second to die. That might be why they're not buying it, but they are buying it when they buy a One America. So they may not be aware of it. They probably, in all sincerity, I think most people that buy a hybrid, if you're a long-term care person, even agents will probably be the first to admit that some of those future values, some of those illustrations get awfully hard to explain to clients. So yeah, I bet you a lot of clients don't really understand how the life portion works of a hybrid. That's probably accurate. But it is a second die in the One America. Let's see. If you break up and expect to sell life insurance when you break this product up, you better ask the questions that they're interested in life insurance. If not, the purpose of breaking up is to sell traditional instead of hybrids. And that's the point here. So yeah, ask them, why are we doing a hybrid? Do you need life insurance? Do you need to have $240,000 of additional? Or are you just looking to get your money back? Let me show you some other ways to get your money back if that's what you're concerned about. So that's kind of hitting the same thing there. Harry, I appreciate that. There's another comment. I'm just going to kind of read this. So this is Randy, but it depends on the health and age of the assets. Those that are 70s with significant IRAs would be better off looking at a hybrid. And I can argue that. Randy, that's a good point. So when you have these people that have this money that has to be moved, this is why hybrids kind of, in my opinion, this is a good fit for them. But what we're seeing is 95% of people that are writing hybrid it's not because of the IRA situation. It's not because they have dead money through it. They're just buying it to avoid use it or lose it. So in my first presentation, there are some good reasons to sell hybrids. All right. With very few exceptions, I agree. You're better writing traditional long-term care and selling instead of breaking them up. Thanks for that. I appreciate that one as well, Jeff. A lot of people are agreeing with the concept. They're saying they use a slightly different version of this. This is what I'm talking about. Let me close with this real quick. There are different ways to skin this cat. The worst one is using a hybrid. Like that's we got to get rid of that thought. You can use second to die, first to die. You can use, if it is maybe a 1035, maybe you buy just traditional long-term care with that or of some kind. Use some of that money and fund a long-term, use your 1035 exchange on a life policy, but then go ahead and buy a long-term care policy because you can't exchange that portion of it. Anything in between. The only thing I want to say is you're almost always better off to separate these policies out. So I'll say this to close. Our number is 800-842-7799. Marketing at GoldenCareUSA.com. If you have a case, if you have something you want to bounce off us, if you want to even talk about the very things we talked about today, give me a call. I'll be busy probably for the next hour, but this afternoon I should have some time, or tomorrow. Love to talk to you more about this. I did get several calls yesterday for some very well-versed long-term care folks around the country, and had some good points for me. I'm always welcome to take those calls. If there's a flaw in what I'm doing, please let me know. But the biggest thing is lean on us. This is a newer concept. I get it. Call GoldenCare. Talk to John, myself, Chris, Tom, Lynn. Any of us will be happy to help you separate this thing up. Bring us a hybrid quote you're working on. We'll put together a life and a long-term care for you that'll be a better solution for your client. Okay? So with that, I want to thank you so much for coming on board today. Thanks for all the positive feedback and all the comments I'm getting. Let's keep this conversation going. Let me know if there's an agency or a group of people you want me to present this for, or let me know how I can help you. But I want to thank you for coming on board. And again, our number is 800-842-7799, marketing at GoldenCareUSA.com. Thanks a lot, everyone.
Check out our website, GoldenCareAgent.com, or give us a call at 800-842-7799.